Awesome, and here we go. Hey everyone, Larry Bailey here with Ridge Lending Group. Welcome to another week with Live with Chaley. We meet every Tuesday starting at 4 p.m. Eastern, 1:30 p.m. Pacific, or in my case right now, 10:30 a.m. Hawaiian time. Aloha to those that are in the group from Hawaii, I being one of them right now, temporarily. Chaley's not going to join us for today. It's going to be me and you on today's session. So, as always, if you have any questions at all with the information that we're sharing on the screen, go ahead and feel free to enter it in the chat. Or if it's convenient for you or you're comfortable, go ahead and take yourself off mute and we will go through it. And we'll go ahead and post a replay up for those on the community if you didn't have a chance to make it. So welcome, welcome, welcome. Today is July 12th, 2022. And for today's Live with Chaley show, I wanted to kind of go through some things that we typically don't have a chance to go through because we're typically digging into Chaley's knowledge and experience helping real estate investors. I thought it would be really great to go through the guidelines that we use. These are called matrices. And on screen, I have an example of what a matrix looks like and why it matters. Because I think in today's market, you might not necessarily be tied into all the different guidelines and all the different things that really impact your ability to obtain financing. But I thought it would be really good for today because we've never done it before really, but to actually show you what some of these guideline matrices look like to help you understand whether you're looking at this today, July 12th, 2022, or at some point in the future. Sometimes it's really hard for us as Ridge Lending, as a lender, to explain all of the different loan programs. If Chaley were here, I'd say, Chaley, how many times have we not been able to provide a loan to a client? And she would say, I probably only need one hand, and I don't even know if I need that, because most of the time you're able to qualify as a borrower in some product somewhere. Now, that of course is tempered with the idea of what are you trying to do and what is available. So what I am going to try to do today, as eloquently, skillfully as possible here on screen, is to walk through some of the what are called non-QM or the non-qualified mortgage products. These are non-Fannie Mae, Freddie Mac. If this was 10 years ago, you might have called them Alt-A. If this was 20 years ago, you'd probably call them subprime. So this is really what we're going to get into today. They're called non-QM. And that just simply means that they're not qualifiable mortgages or qualified mortgages, which is defined under the Dodd-Frank Act, also known in that end. There are a lot of different ways to define it. I'm going to do my best to keep admitting people here into the meeting and answering questions. So first question, Gloria, thanks for asking, does Ridge do ARMs? 1000% yes. An ARM is just a type of amortization. So an adjustable rate mortgage, yes. The products that we're going to go through today, if it calls out an ARM with a special overlay or a special restriction to a guideline, I'll call that out. But generally speaking, ARM products are follow the same guidelines as fixed or FRMs, fixed rate mortgages. But again, if there is a call out or an overlay, I'll do my best to call that out. Always best to make sure you check with your dedicated lending specialist at Ridge Lending Group. If you have any questions, again, if you have any scenarios, you can always email it to info@ridgelendinggroup.com, or you can always call 855-74-RIDGE. So the first one I want to talk about was unique for me because, again, some folks that are listening may think these are really high dollar numbers. But if you go into California, as an example, or Hawaii, where I am right now, the LTVs are helpful, mostly because when you get over 80% loan to value, you're typically used to looking and worrying about private mortgage insurance. And what this product here, this is our V series, what this series allows us to do is to go above 80%, even for a primary residence, even for cash out. And you don't have to worry about a separate PMI underwrite. You don't have to worry about a separate PMI cost. It's built into the product. So as we see on screen, of course, everything is related to credit score. If you're not sure what your credit scores are, and you're wondering if this is the right product for you, you can certainly check with your DLS. Ridge does have the ability to do a soft pull. In English, it means that it's not a hard pull, right? So what we do is we go into the credit bureaus, not on a hard request for credit. You're just wondering what the scores are. So we can, I'm gonna grab a drink here. We can check with the bureaus, see what your scores would be on that soft pull, try to qualify you through that. But the significance here is, again, with your loan amounts, this is the loan amount financed. So if you were looking at a purchase, or if you're looking at a refinance, credit scores based upon your loan amounts up to these specific loan to values could be significantly important for you. It doesn't happen often, but if you do have a mortgage late on your credit report, it's not a deal stopper. Sometimes things happen, but it's not always the case. So in this particular product, you can't have any housing lates just in the last 12 months. So if there was a housing late that showed up, you could have a timeline here where as long as there were no lates in the last 12 months, you're okay. Also, a call out here is if you have any bankruptcies, foreclosures, or modifications on any mortgages on your credit, as long as they're greater than 4 years, again, it's eligible. There are some state restrictions in here for Connecticut, Illinois, New Jersey. Ridge doesn't do New York, but where there are limits to those loan to values. So just to kind of come down, this product is really, you talked about ARMs, Gloria, so these do allow for ARMs. Some of the other call outs here talks about properties, it talks about acreage, things like that. And the only time that, with regards to income, these are going to be your standard forms of income. I wanted to kind of move forward into the next part of the V series, which is alt doc, because we see a lot of this in today's market. We're doing a lot of debt service coverage ratio loans. This is where I think Chaley talked maybe 2 meetings ago about using different loan products with bank statements, or just using 1099 or asset utilization. Again, this is primary residence where you can go higher than an 80 LTV, in this case up to a 90 LTV, depending on your credit score. And again, some of these guidelines on here are identical in terms of what we're doing for loan to values and things like that. The difference is between the first page and this page is what is the source of income. So it's just kind of another call out. If you've got alternative forms of income that aren't necessarily on your tax returns, make sure you let us know what's going on so we can try to help out at Ridge and get a best answer for you. So I thought this was an important one to call out, specifically because it addresses the use of bank statements, also cash flow, 1 year of 1099, as well as asset utilization, where you're drawing down your assets in order to qualify. So that was cool. There's other cool things we're going to go through here in the V series as we go down. So just as a call out, if you are using a 1099, it's 2 years or of taxes, or 1 year of the 1099. You get your fixed expense ratios if you're using that. So in other words, if you get 100,000 in a 1099, they're only going to use 90,000 of that for qualifying. And then of course, continuation of receipt of that income from the same source is important. So asset utilization, this is important here, where assets must be divided by 84 months to determine a monthly income stream. So if you had $1 million, divide $1 million by 84, and that becomes your qualifiable income stream. So kind of cool stuff. If we go further down into the V series, there is issues where maybe you had housing events. So what this is important is this talks into real life, right? I mean, I've personally been through bankruptcies and foreclosures, horrible time of my personal life, but that doesn't stop me from wanting to own property. So I mean, welcome to America. So if you do have 30-day lates, but not 60 or 90-day lates, you can be eligible here for financing. Same thing goes if you had a bankruptcy, as long as it's greater or equal to 36 months, or 12 months or 24 months. There are ways to work through this, and that includes for any bankruptcies that, if you have any property where you're trying to invest in property for investment purposes or second homes. So it is possible. Again, not for everybody. You never know when it's going to happen to you or someone that you know, but it is possible to still obtain mortgage financing not that far after something is bankruptcy or foreclosure. Eddie, do you have a question? No. We'll keep going. All right, so that was, I wanted to call that out because it was interesting to me, because again, 10 years ago, you'd call that alt-A, 20 years ago, you'd call that subprime. But today, we call it non-QM. So I thought that was interesting. Let's see here. What else is interesting? Down below, and I'm gonna post this information in the replay, so you don't have to worry about following along on the screen. So debt service coverage ratio. I know Chaley's talked about this more than a few times, but as a reminder, this is where you don't need any income from yourself, don't need any employment from yourself. It is specifically, does the property support its own mortgage payment by either a ratio of 1 or even less than 1. And there are specific restrictions here in terms of housing history or credit event seasoning, things like that. You also, for a debt service coverage ratio loan, this is another call out or an overlay where you must have a history of owning and managing non-owner occupied for at least 1 year in the last 3 years. So if for some reason you don't have at least 1 year in the last 3 years, then you're going to be considered to be a first-time investor. And as such, you're going to have credit score requirements elevate and your loan to values be decreased. Again, it's mitigating risk. So I thought that was important. It's also very important. Debt service coverage ratio loans, typically in New Jersey, have always been reduced because New Jersey is just a wonderful state to invest in real estate. So that, these are some call outs for that reduction. Also, in this particular case, if the property is currently vacant, there could be, in this case, there is a reduction in the loan to value matrix because of that. But I want to draw this out. If you're having some issues with your credit score, we can go down as low as a 640 up to $1 million, as long as the property is not vacant and you're not in New Jersey or Connecticut or Illinois. We can go to a 70% loan to value when you have a purchase or a 65% on a rate term refinance or 60% cash out. And if you look up in here, if we have a debt service coverage ratio of at least 1, you can even go down to a credit score of 600. These are things that we don't typically talk about at Ridge because most clients that we work with have higher credit scores. And that's a beautiful thing, but it's not always that way. Or you might know somebody who maybe wasn't getting a fair shake in their application for a mortgage because their credit has gotten dinged up or overextended. Again, crazy things happen in life, and these are important. I thought it was important to share. So these are all single family properties, investment properties. I think the last part in here that I wanted to go over is really important because we haven't talked about this at all. So debt service coverage for a 5 to 8 unit or a 2 to 8 unit with mixed use. So hopefully everybody's catching what I'm throwing down here, because mixed use, I've never heard us talk about. And this is a guideline that I know I've seen a few clients come through with questions about mixed use. And then also if you've got 4 to 8 units, this is now something that we can take through debt service coverage without sending you over into commercial. Eddie, you have a question? You have a question, Eddie? I'm gonna see if I can take you off mute here. Or are you just saying, hey, you don't, you're just saying, hey. Well, if you have a question, Eddie, go ahead and take yourself off mute or throw your question up in chat. Thanks for coming today. So what's really cool about here again is you've got a multi-unit. Typically, we only go up to 4. That's what we're used to doing.
Oh, Larry.
Yes.
Oh yeah, I'm back now. Yeah, I was. It's not a question, but I was gonna say that I wish your service you do landing in New York. I know I asked that question before.
I know.
And yeah, that's all I just want to say. That's all.
I appreciate that, Eddie. Yeah, New York is a special kind of place to be a lender, and we're just not interested in that effort right now. But I do appreciate your comment. Thank you. So Gloria asks, I have an 8-unit apartment. Would that qualify for a refi or something else to free up equity? Well, so here it is on the screen, Gloria, and this is exactly why I'm bringing it up. So thank you very much for your question, but you can do a cash out. Here's your credit score ranges. Here's your loan amount ranges. And as long as the property has a rent roll that carries the mortgage PITIA, well, you wouldn't have an 8-unit, but PITI, as long as it carries it for at least 1 or greater, then you can do a cash out refinance to free up equity.
Okay, thank you.
Yeah, thank you. Here is a call out again, first time investors not eligible. So if you are first time and you happen to own a 5, 6, 7, or 8 unit, or you've got a mixed use property, this product would not fit for you. And this is available for ARMs. Does talk about unleased units and multi. So there is a cap on how many vacancies, depending on the type of property, those kinds of things. And there is a call out here for how many units, what does mixed use mean, right? So in 2 to 4, if you have an 8 unit, you can have 3 of those be commercial, which is pretty cool. So it's at least, no greater than 50. I hope you can see it. So basically, as long as the commercial does not exceed the residential, that's the call out. So they can't be equal and they can't exceed, as long as the commercial space is not greater than 49%. You're cool. So I thought this was really great. Obviously, these kinds of properties have a specific kind of appraisal. So the appraisals are absolutely going to be more expensive. How much more expensive? Depends on your property. But typically anything that's more than a standard Fannie Freddie appraisal will be more than what you would expect. So I think that's the for me. I saw this and literally early today when Jayla and I were talking about this. This is the one thing that stood out to me is the 2 to 4. Strike that, please. Is the 2 to 8 mixed use as well as the 5 to 8 residential? Because typically when we talk about there's Jayla. When we talk about lending, we typically talk about 1 to 4. And this changes that narrative quite a lot. So there you go. So that was the V series. Any questions from anybody before I move on? If you do, let me know. If you have any questions while you're watching the recording, put it in the community, or like I said, reach out to Rich Lending anytime. I want to also talk about the D series. So in the D series, what we typically talk a lot about in the D series is the debt service coverage ratio loan. We've probably received, I don't know the exact number, but we've received a lot of requests recently for debt service coverage ratio. And I imagine that's because folks are having trouble qualifying using their tax return, or their tax returns are complicated situations and they feel like it's best just to go debt service coverage. The reason why I bring this up over here, even though we just saw it in the V series, is specifically because you can do interest only product with this. So that's come up a lot as rates are trending upwards. Interest only with a fixed rate mortgage instead of an ARM is something that comes up. I can tell you that the interest rate differences for the interest only versus the longer term fixed rate mortgages, for me personally as an investor, it doesn't make any sense to take that risk and go to an interest only versus a full amortization, specifically because in the first 5 years, as Chaley's gone in before, the difference is minuscule. It might be impactful for you, so you have to investigate it. You have to see where the numbers take you, take the emotion out, and see where the math leads you. But ultimately, I want to make sure everybody understood that it was possible. I also wanted to bring up foreign nationals. So in this, both in the V series as well as the D series, we do have the ability to do foreign nationals. So coincidentally enough, earlier this week, well, today's Tuesday, so I think it was Friday actually over the weekend, a few days ago, there was an investor out of Canada who wanted to purchase a property in the United States. Totally, perfectly great. Take an application, and it's considered to be foreign national, so not a big deal to do that. So if you have that situation, or you know of somebody who has a situation that needs a foreign national loan, let us know. We'd be glad to help. And I think that was the part that I wanted to call out. Yeah, that was the only part that I really wanted to call out on the debt service coverage, was the foreign national on here. So the takeaway for today's, Live with Chaley pieces, of course, Chaley couldn't be here today, so I apologize. But I wanted to focus this time on reviewing products, because when I started in lending in '93, there was basically a set of guidelines that we would refer to, and we had our most used 6, and then we always had these products that you just had to have somewhere in the back of your head in case the situation arose to help a borrower through. And I feel like we spend so much time talking about Fannie Freddie and 10 golden tickets. I think those are very important, but I think as the market continues to mature and evolve in 2022 and on, and investors are getting different kinds of opportunities and expanding their portfolios, I wanted to let the community know, let you guys know we're showing up, that you do have options if you need them. So before we go, and for those that are just showing up, I appreciate you coming. We were talking about the different kinds of series of non-QM loans that Ridge Lending Group can assist you with. And so we went through everything from jumbos and credit issue loans. And then, of course, we got into the multi-unit. I'll bring that back up on screen because I love it. The multi-unit debt service coverage for 5 to 8 or mixed use. Thought that was great. And then, of course, I'm getting over into some foreign national programs. Does anyone have any scenario questions, situations that you heard about, whether for yourself or someone else, that I could try to isolate for you or answer for you? I'll check chat. I don't see anything in chat, so that's okay. I don't see anybody with any hands raised. I'm looking over at a different screen, and on the community, someone just asked, which I'll talk about here, so it's kind of funny it happened. Patty in the community asked, what's the approximate savings on the ARM versus DSCR loan? So Patty, we're here. What I'd say to Patty is, first of all, ARM and DSCR are not the same thing. An ARM, an adjustable rate mortgage, is a type of amortization, and a DSCR is a loan product used for qualifying. So, Gloria, you had the same question. Oh no, you had a different question. So the takeaway is debt service coverage ratio is like pay stubs, bank statements, W-2s, 1099s. It's a way to qualify for the mortgage. An ARM versus a fixed is the amortization. An ARM can change literally from the get-go and change every month from the get-go, or the initial interest rate can be locked for 3, 5, 7, or even 10 years, depending on it. So that's how those products work. Gloria, for your question, Thanks, Kairon. I'll get to you next. Glory, for your question, what's the difference between ARM and interest-only loans? Great question. So an ARM, again, adjustable rate mortgage, is a method within your mortgage that allows the lender to change your interest rate over the course of the note. So in English, if you had an adjustable rate mortgage that starts at 5%, and within the terms of the note, the lender has the ability to change that interest rate every month, or every month after the first 3 years, or every year after the first 5 years. There's lots of different ways to structure an adjustable rate mortgage in terms of terms. The interest only has to do with the repayment feature of a mortgage. So typically when you repay a mortgage, it's fully amortizing. Even if it's an adjustable or a fixed, it's still fully amortizing in the mathematics of the repayment. So again, in plain language, if you borrowed $100,000 and the monthly payment was $600, at the end of that term, you would owe zero. Interest only says during a certain period of time, the borrower, you, is allowed to only pay the interest accrued on that note without being responsible for repaying any principal. What typically happens in interest-only loans is there's an interest-only period followed by a fully amortizing period. And usually that jump is a hard jump for people's pocketbooks. So a lot of times people will do a 40-year interest only. And what that does is the first 10 years are interest only, followed by 30 years of fully amortizing payments. And that helps the payment shock from the interest only period to a fully amortization period. But it's not unusual to see interest onlys on ARMs, mostly because you're trying to get the lower rate and you're trying to get the lowest payment because you don't have any principal repayment during that period. But I would tell you, Lori, if you have further questions about a really specific situation, we can go into details if you want, but hopefully that answered your question. Kyron, thanks for the question. So thanks for the question, Gloria. Kyron, thanks for the question from you. And what about building a quadplex with good credit score? So do you mean construction, Kyron? I'm pronouncing your name hopefully correctly, but are you talking about construction lending, or are you talking about a building like a quadplex, which would be just 4 units? Both. Okay. So construction lending, I couldn't tell you a thing about. So construction lending, you typically, Ridge Lending Group typically only gets involved on the takeout financing, and it's a 4-unit. So if you're eligible for Fannie Freddie, we'll take you Fannie Freddie. If you're not eligible for Fannie Freddie, we'll take you non-QM. We have worked with companies that provide for the construction, and it's typically a short-term loan. You don't know where you're building in the country. You don't know any of that stuff in terms of availability and timing. Florida. Last time I checked, anything in Florida has taken like a year to build, unless you know somebody special. So, the staging for that, 18 months, geez, oh man. I got nothing for you. Chaley I can take this as a takeaway, Kyron, if that's helpful. But 18 months, I mean, that's 2024 right now, right? So I wish I had better information for you. I don't know who's offering that. Typically, my experience in construction financing is so old and dated. I'm embarrassed to even try to give you anything meaningful. But I will follow up with Chaley to see if she has. You got it, Karen. Thanks for the question. Sean, does Chaley only do 30-year loans? So yes, some of our products will close in the name of the LLC, Sean. So yes. And as far as only do 30-year loans, that's a term, and the answer would be no. We do terms as little as 10 years and terms as long as 40 years. Now, putting those two sentences together would depend upon you. So what I would have you do, if you're not already working with a dedicated lending specialist at Ridge, call 855-74-RIDGE or email info@ridgelendinggroup.com and say, hey, I was just talking to Larry at today's Live with Chaley. I need this. And we'll get you coordinated with somebody and get you hooked up with a DLS team member and get you an answer. You got it, Sean. Thanks for the question. Jonathan Reese, how you doing, sir? So if it's an investor and not owner occupied, we can. Oh, okay. So so going back to Chiron, if again, that's why I would follow up with Chaley. So Chiron, if you like, send an email into info@ridgelendinggroup.com exactly with what you need, terms and everything, like spell it out. What's also going to be important is to spell out what your experience is. It's one thing, and again, this is a general statement. This is not about Chiron in particular, but generally speaking, if somebody's got a pipe dream, and I've had plenty of pipe dreams, so this isn't a knock on anybody. This is just reality. Going back to like what we see on screen, if you're a new investor, if you're a first-time investor, getting an 18-month construction loan on a fourplex, it's probably a tough road. If you're experienced in doing that, you've got a great portfolio, and the bank can understand what you're doing and how you're doing it, how you can support that transaction for the next 18 months and beyond, great. And so that's something that, again, it's not that we can't do it, and not that I don't know those answers specifically, but my intention was to follow up with you, Chiron, after I catch up with Joe. So, awesome. That's great. So thank you, Chiron. Yeah, send the email. I'll make sure Chaley sees it. She sees all this stuff. Like she's an all-knowing person. Mark the screen. It's pretty cool. Gotta love Zoom. Any other questions? Comments, scenarios? As always, we'll do these things every Tuesday. Chaley does try to make it every Tuesday, but sometimes things happen. So I appreciate everyone coming, and we'll get this replay up for others in the community. And as always, if there's anything we can do just to answer questions and educate, that's why we're here. You can always give a phone call or send an email to Ridge Lending Group. Check out ridgelendinggroup.com. We're also putting stuff on our blog. It's under articles, and the YouTube channel and other social media stuff. We're always posting stuff out there. So even if you don't necessarily hang out on the community all the time, you can go check out the YouTube, Instagram, Facebook. I think we do stuff on Facebook too. But whatever floats your boat. Thanks, gang.
Thanks, Larry.
Of course.
Bye.
We'll see you. Have a great day, everybody. Thanks for coming. Bye-bye
Thank
now.
you.